Hi, I'm Theoret, currency strategist at Scotiabank. We've seen a considerable amount of movement in the euro on a year-to-date basis. The single currency spent the first month of 2018 extending the 2017 bull run and reached a multi-year high above 125 by mid-February. The euro subsequently fell 8% after a short period of consolidation and tested a near one-year low of 115 by late June. Let's take a look at some of the causes behind this move and what's ahead for the euro. One of the major surprises for 2018 has been the unexpectedly strong economic performance of the United States and the slight moderation in the pace of growth for the euro area. The US economy has bucked its seasonal trend of Q1 weakness, benefiting primarily from the delivery of fiscal stimulus and continued employment growth. The euro area's soft patch has been largely attributed to weather-related issues, and the recent recovery in purchasing managers' indices and rebound in industrial production data would suggest that the Q1 weakness was indeed transitory. These unexpected economic circumstances in the US and euro area occurred at a time in which bullish positioning in the euro was at record levels. The timing could not have been worse and forced a considerable adjustment on the part of euro bulls as they were forced to liquidate their record-long positions. Fundamentally, these unexpected growth surprises delivered a firming in expectations for US Federal Reserve tightening and a delay in policy normalization from the European Central Bank. The Fed executed a pair of 25 basis point hikes in March and June and maintained a bias for continued, gradual tightening. The market responded accordingly by adding one additional hike for a total of 4 Fed hikes in 2018. At the ECB, we saw the introduction of a short taper, an extension of the balance sheet expansion from September to the end of 2018. The June ECB meeting also saw President Draghi deliver clear forward guidance to push out expectations for modest rate hikes towards the second half of 2019. Markets are currently pricing in just about 5 basis points of ECB tightening by the end of next year. The net result of these two fundamental developments ultimately supported the US dollar on the basis of wider interest rate differentials. The US dollar now appears very well priced in terms of the near-term Fed path at a time when markets appear to be pricing in very little for the ECB. This would suggest that there's very little upside for the US dollar on the basis of Fed expectations and very little downside for the euro on the basis of market expectations for the ECB. The Fed is slowly approaching the end of its multi-year normalization plan just as the ECB prepares to begin. Recent experience has left markets either unable or unwilling to price much in terms of ECB tightening, and we've actually begun to see verbal intervention from ECB policymakers attempting to guide rate expectations higher. We see the outlook for relative central bank policy as being unequivocally supportive for the euro. The Fed is gradually approaching the end of its tightening cycle and closing in on a neutral policy rate. Trade tensions are also at the margin, injecting additional caution to policymakers' recent communications, and we're observing a subtle shift in the Fed's tone. We're also likely to see more verbal intervention from the ECB as they attempt to lift rate expectations for 2019 and beyond. We currently hold a bullish forecast for the euro, targeting modest gains by year-end and considerable strength in 2019. Specifically, we hold a year-end 2018 target of 120 and a year-end 2019 forecast of 135. You can find more in-depth global currency analysis on our website, and you can also follow us on Twitter at Scotiabank GBM and at Scotiabank FX. I'm Theoret. Thanks for watching.